welcome to this week's edition of Echo45 Advisors Market and Economic Update. In this week's video, we'll be discussing the market's return to all-time highs, as well as the state of the U.S. consumer. This is an important topic right now because markets have experienced a volatile year. For some investors, it may feel like it's been a terrible year for returns when really the opposite is true. The Dow recently eclipsed 40,000 for the first time, and most major market indices are near record levels. This is because markets have swung quickly based on economic data and expectations around the Federal Reserve. Over the next few minutes, we'll talk about perhaps the most important economic topic, the financial health of the U.S. consumer. First, this chart shows the level of household net worth over the past 3 decades. As you can see, there's been a steady rise in net worth due to the growing value of financial assets, such as stock and bond portfolios, and non-financial assets, such as homes. Specifically, net worth tends to increase during bull markets and when home prices are rising. This is clearly one of the main drivers of wealth, not just over the past few years, but over history. This shows that the stock market tends to increase consumer balance sheets and their financial health. However, the opposite is also true due to what economists call the wealth effect. This is simply the fact that consumers tend to spend more when they feel more financially secure. So, when consumers feel that they're doing better, either because they have higher wages, their investment portfolios have grown, or their home prices are rising, they tend to spend more on goods and services. In turn, this boosts corporate revenues and can help stock prices over time. Second, although net worth has increased, the level of consumer debt has also grown. This means that for many households, the burden of monthly payments has increased, especially as interest rates have risen. Specifically, total credit card debt in the U.S. has jumped to $1.1 trillion, and auto loan debt is now at $1.6 trillion. Delinquency rates have accelerated. According to the Federal Reserve Bank of New York's latest household debt and credit report, credit card delinquencies have risen to almost 9% of balances compared to the 10-year average of only around 6%. Consumers are also saving less today than they have historically, especially when compared to the pandemic years when savings rates skyrocketed. So, while households are doing very well on average, many continue to struggle under debt loads and higher monthly payments. Finally, this chart shows the level of consumer sentiment. These numbers can fluctuate significantly from month to month as consumers are impacted by many factors. Most recently, sentiment has been poor for all the reasons that you might expect: higher inflation and an uncertain economy. That said, unemployment is still exceptionally low and wage gains have been generally strong. If inflation can continue to come down, as it did in the latest Consumer Price Index report, then hopefully sentiment can improve. What does all this mean for long-term investors? Consumer spending is one of the cornerstones of economic growth in the United States, and the fact that consumers have been strong is one reason markets have rebounded and reached all new highs. So it's important to focus on these longer-term trends rather than day-to-day market news. We hope you found these insights helpful. If you would like to discuss any of these topics in more detail, please don't hesitate to reach out. We look forward to speaking with you soon.